Hi everyone, welcome to my lecture. In this video, I am going to discuss about financial reporting framework, and this concept covers the financial reporting characters, financial reporting framework. By the way, my name is K. Kiran Kumar, Assistant Professor, Christianity College Autonomous, Bangalore. First, we will study the importance of conceptual framework. A conceptual framework is a set of theoretical principles and concepts that underlie the preparation and presentation of financial statements. So, this framework is the combination of principles and concepts. If there is no conceptual framework, then accounting standards would be produced on a haphazard basis as particular issues and circumstances arose. That means if there is no particular conceptual framework, there is a chance of arising some errors or problems. These accounting standards might be inconsistent with one another or perhaps even contradictory. It means there is no chance of comparing with the other reports for finding out the financial performance between the two companies. That is why a perfect conceptual framework is required for avoiding this kind of problem. A strong conceptual framework means there are principles in place from which all future accounting standards draw. It also acts as a reference point for the preparers of financial statements if no accounting standard governs a particular transaction. So, particular accounting standard required, and these conceptual framework will be treated as a reference. Next, the purpose of the conceptual framework. Board, when developing new IFRS standards, helping to ensure that these are based on consistent concepts. So if there is a particular conceptual framework or systematic framework, the reports may be inconsistent concepts. Even preparers of financial statements, when no IFRS standard applies to a particular transaction, or when an IFRS standard offers a choice of accounting policy, the conceptual framework is required. All parties, when understanding and interpreting the IFRS standard. So here, all the companies able to understand the annual reports and interpret the financial. So without the conceptual framework, consistency, understanding, and interpretation is not possible. Next, the objective of financial reporting. So the main purpose of the conceptual framework is providing information about the company to the investors, lenders, and other creditors that will enable them to make decisions about providing economic resources to an entity. So when a company prepare their annual report based on the conceptual work, then investors, lenders, and the creditors can able to take the decision. That is why financial concept or conceptual framework is required to follow. If investors, lenders, and the creditors are going to make these decisions, then they require information that will help them to assess the future cash flows and the usage of the economic resources. To assess the company future cash flows, the investors or lenders need information about the economic resources of entity, that is assets, and economic claims against the entity, that is liabilities, changes in economic resources and claims, that is income and expenses. So these three are very important to assess or evaluate the company performance. Qualitative characteristics of useful financial information. So qualitative point of view, fundamental characteristics and enhancing characteristics. So fundamental characteristic is relevant and a faithful representation of company's transactions. First one, relevant. That means Here, information should be relevant or useful or related to the investor's expectations or related to the creditor's expectations. Relevant information should be provided by the company. Next, a faithful representation of an entity's transaction. So faithful means without any error or as per the particular country accounting standards, those companies should prepare their financial report. So the report should be complete, neutral, free from errors like exercise students. Next one, enhancing characteristics. Information should able to compare with the other companies or able to compare with the industry. Next, timeliness. It means different countries have a different accounting period. Example, in India, accounting period or financial accounting period, April 1st to March 30. Next, verifiability. Financial report should able to verify, able to understand. Okay, verify in the sense if an investor or a creditor have a doubt with any transaction, he may have a right to ask or he may go through the complete details. Reports also should understandable. Next, financial statements and the reporting entity. The conceptual framework knows that financial statements are a particular type of financial report. The purpose of financial statement is to provide information to users about any company. So here financial report contains the five important major components, that is assets of the company, liabilities, equity shares of the company, income and expenses of the company. The information is provided in a statement of financial position, statement of financial performance, other statements like cash flow statement and fund flow statement. So these statements are generally prepared on the concept of going concern. So being an accountant, he should prepare the report by keeping this concept a going concern concept. These reports will help the investors will take decision. Thank you for watching my video.